We've got rising unemployment, enough already that everyone is talking about it. But that just means rate cuts, right? I mean, a soft landing implies there's going to be a little bit of weakening in the economy and labor market to begin with. So if there's any danger of it going too far, in steps the mighty Federal Reserve with just the right amount of stimulus to steady the whole situation. It's a nice story, but that's all it is. It's just a story. Rate cuts are superstition unbacked by any facts anywhere, and this is not arguable. The data is absolutely clear and conclusive, as you'll see here in just a few minutes. Finance and small e economics always leaves open at least a little wiggle room. It's a dynamic and complex world, so it's rare to find a definitive case. There's always some ambiguity, so you could say, well, maybe, possibly, there's at least a chance. In the case of rate cuts in the economy, nope, not even close. The evidence leaves no room for interpretation. Rate cuts don't work. As I said, they are a superstition. One that was invented by a Federal Reserve which had been left behind by a monetary system that evolved without it. Targeting the federal funds rate by default, and you don't have to take my word on this, I'll give you the full quotes here too. Officials in an army of Fed-adjacent academics built up this mythology of mighty interest rates because they had no choice. It was either that or shut the whole thing down. And as we know, bureaucracies don't ever go away, and certainly not voluntarily. The Greenspan put has been put to the test repeatedly. And like everything else the Fed does, the results are unquestionably ugly. But it is you and I who end up having to pay for it. So let's start with what the mainstream narrative is as far as rate cuts, because as the world continues to move in this direction, the US economy in particular nowadays, rate cuts are all the rage. As PBS noted not all that long ago, the average person, their view of rate cuts, this is a pretty good summation of it. Ever since the Federal Reserve signaled last fall that it was likely done raising interest rates, Wall Street traders, economists, car buyers, would-be homeowners, pretty much everyone began obsessing over a single question. When will the Fed start cutting rates? And unfortunately, this is true. The Fed typically cuts only when the economy appears to be weakening and needs help. Lower interest rates would reduce borrowing costs for homes, cars, and other major purchases, and probably fuel higher stock prices. That's already happened. All of which could help accelerate growth. I do like the fact that they put a little bit of wiggle room in their statement here. Could help accelerate growth. So as far as the average person goes, it sounds intuitive, it sounds straightforward. If lending costs and borrowing costs go down, that should be able to help the economy, especially one that is showing signs of weakening. If it becomes cheaper to buy things, then people will be able to buy more things. That will mean more economy, more hiring, more workers, more income, all the good stuff that you hear about when it comes to stimulus. But it isn't just the average mainstream media source. Even those in the financial services industry, they have heavily bought into the idea of the almighty Fed. Here's an example from Morningstar from just a week ago. We expect gross domestic product growth to weaken over the next year before beginning to reaccelerate on the back of Federal Reserve rate cuts. Growth will be weaker than normal, but still positive, thus avoiding a recession. This period of weaker growth should cool off the economy and ensure that inflation returns to the Fed's 2% target. Basically, the Goldilocks soft landing scenario. Soft landing, as I said in the intro, implies a little bit of weakening, but in comes Jay Powell swiftly, steadily, and just at the right moment with his rate cuts to steady the economy before it gets to recession. It's a nice story, but it's all superstition. And this is why Eurodollar University has memberships and subscriptions to help you understand these things and sort it all out. And those memberships and subscriptions are on sale at some of the best prices that we've offered since we founded Eurodollar University a couple years ago. We got memberships with tons of videos on everything from the basics of money and financial concepts, especially interest rates, even the basics of QE and QT. You won't get this stuff anywhere else. I have a daily deep dive to dive far deeper behind all of the topics I bring up here on YouTube, and we talk about interest rates theory and practice all the time. The daily briefing keeps you up to date on everything that's happening in money and macro. And in addition to the anniversary sale, I'll be hosting a live stream here on YouTube next Tuesday night, July 23rd, 6 to 8 p.m. Eastern Time. Eurodollar members and subscribers will be able to ask me and a whole bunch of my guests some questions live. So check out our website for details on the anniversary sale as well as next Tuesday's live stream. It's all at our website, eurodollar.university. So where did this idea of interest rate targeting even come from? Well, it goes back a long ways to the Eurodollar revolution that started in the 1950s and 1960s and on into the 1970s. Essentially bank money in an international setting. The second stage of the evolutionary ledger money process that I talked about in a presentation I gave recently, and you can find that video here on our YouTube channel. But basically, as the monetary system evolved in various different ways, it left the Federal Reserve behind, as Paul Volcker found out the hard way in the late 1970s and into the early 1980s. So officials had to come up with something using the federal funds rate, otherwise it would have meant closing the doors and shutting the whole thing down, which is probably what they should have done. And again, there isn't any ambiguity on this matter either. Alan Greenspan himself admitted they had no alternative but to see if targeting the federal funds rate might be somehow helpful. As he said in a discussion, a very important discussion in 1991, I must say I'm quite reluctant to cave in, if you will, on this question that we can do nothing but target the federal funds rate. This issue arises largely because what we are doing de facto is targeting the funds rate. I'm not sure that any of us believes that that's the right policy. They had no other alternative. And they kept waiting through the 1980s and on into the 1990s for money demand functions or money supply itself to somehow go back to the way it used to be before, and the Federal Reserve could go back to targeting some kind of monetary aggregate. But instead, as Alan Greenspan again admitted later in the 1990s in 1997, nothing changed. This is all that they had. What he said in 97 was, increasingly since 1982, we have been setting the funds rate directly in response to a wide variety of factors and forecasts. We recognize that in fixing the short-term rate, we lose much of the information on the balance of money supply and demand that changing market rates afford, but for the moment, we see no alternative. In the current state of our knowledge, money demand has become too difficult to predict because money itself completely evolved. This proliferation of financial products Greenspan would later talk about in 2001 essentially left the Fed no alternative. It was target the federal funds rate or close the doors. And bureaucracies don't ever voluntarily shut down. So since 1982, they've been targeting the federal funds rate and hoping that by targeting the federal funds rate, it will influence something in either the banking system or the economy, the way PBS described it, the way people commonly view how interest rates work. They were hoping that targeting the federal funds rate, moving it around a little bit here and there, will be enough of an influence that they can claim to be in control of the economy and the monetary. So they even call it monetary policy when there's no money in it. It's interest rate policy, and interest rates, as it turns out, are nowhere near enough of an influence. So let's get to the evidence. And again, as I said, the evidence is conclusive. We'll go all the way back to 1982 because that's when the Federal Reserve decided it was going to start targeting the federal funds rate. The unemployment rate began the 1981-82 recession about 7.2%. And it was that high because unemployment kept creeping up throughout the Great Inflation, as well as the fact that there was a brief but very sharp recession in 1980. So already by the beginning of the 81-82 recession, the unemployment rate's at 7.2%. And that jumped to 10.8% by the time we get to the end of it in November 1982 and December 1982. In July 81, when that recession began, the federal funds effective rate, that's the market rate, was 19% because interest rates go up during inflation, they're not lower. By December of 81, so a couple months, 6 months into it, basically, the federal funds effective rate was already down to 12.5%. While that's still high, you're talking about a 6.5 percentage point reduction. The federal funds effective rate would bounce up to 15% by April of 1982 because again, this was a market rate, so it moves around based on market forces, not some kind of interest rate policy. And by the time we get to September of 82, when the Fed does start targeting the federal funds rate, it goes back down to about 10.3%, 10.25% when the Fed funds targeting starts. But that just means that the effective federal funds rate went from 19 to 10, And at the same time it was going from 19 to 10, the unemployment rate went from 7.2% to around 11%. So what good did lower interest rates, either by market forces or at the end by the Federal Reserve's policy, what good did it actually do the economy? Fast forward to the next business cycle, the S&L recession in 1990 and 1991. This time, we have a full and complete interest rate targeting regime, the one that Alan Greenspan was talking about when he said, I don't really think we should be doing this, but we don't have any other choice. The Fed had been targeting higher interest rates in 1988 and the first half of 1989 because it doesn't understand inflation. They were really concerned that the great inflation was going to be restarting in the late 1980s. So they were going to use this new regime of targeting a federal funds rate to try to snuff out the inflation before it got started. But that already led to some weakening in the economy. By June of 1989, the unemployment rate bottomed out around 5%. And then the Fed started cutting interest rates in the latter half of 1989. The unemployment rate at least was steady sideways for most of the next couple months, and economists thought they had achieved a soft landing. But the unemployment rate begins to rise in July of 1990 as the recession begins, which everyone, including economists and central bankers, blamed on Saddam and his invasion of Kuwait. But there were warning signs about a recession building months before we got to Saddam Hussein. And Greenspan offered just one rate cut in July of 1990 as the recession is beginning. The bigger and more sustained series of rate cuts don't begin until October of 1990. But by then, the unemployment rate, which had moved up from 5%, was at 5.9%. So the Federal Reserve is cutting in more determined fashion from October of 1990 on through the rest of the recession, while the unemployment rate continues to rise. It would not peak until getting to 7.8% in June of 1992. That was well after the official end of the recession, just ask George H.W. Bush. And by then, the federal funds target had been brought down all the way to 3.25% from 8.25% in July of 1990. So 5 full percentage point reduction in the federal funds rate during a recession. And the recession happened anyway, when the unemployment rate went from around 5% up to nearly 8%. So a 5 percentage point reduction in the federal funds target, and actually went a little bit further, all the way down to 3% flat. And the unemployment rate rises around 3 percentage points too. So what good did the rate cuts do? What good was this interest rate targeting policy? And instead, what economists have said is that, well, it would have been worse without them. We get into this argument over the amount of jobs saved because it clearly does not work in the manner in which it is intended. 10 years later, we get to the dot-com period, the dot-com recession, the dot-com bust. Greenspan, again, had been chasing inflation ghosts in the middle of 1990. The federal funds rate gets up to 6.5% in 2000. At the time, the unemployment rate had moved down to 3.9%, and that's where it was as of December 2000, even though the dot-com bust kept on busting at that point. The unemployment rate rose a little bit, and it began its rise in January of 2001, and Alan Greenspan started cutting rates right away. And it got the federal funds target down very quickly from 6.5% to 4% by May of 2001. They did 5 consecutive 50 basis point rate cuts. 5 straight 50 basis point rate cuts. Can you imagine if the Fed did something like that today? But suddenly in June of 2001, that's when the unemployment rate begins to shoot higher. It reaches 5.7% by December 2001 in a move that started after that major series of rate cuts. And Greenspan kept cutting rates. It wasn't as aggressive as the initial period, but he kept pushing the federal funds rate down to 1.75% by December of 2001. And guess what? Not only did it not avoid the recession, we had the recession anyway, unemployment kept rising after the recession was over. It goes up to 6.3% almost a year and a half after the dot-com recession was over. So the Fed brings the Fed funds target down from 6.5% all the way to 1%, and unemployment continues to rise throughout the entire period. So we're back again to, well, it would have been worse without that aggressive series of rate cuts. Then, of course, there's the 2007-2008 Great Not Recession. The unemployment rate was around 4.4% at the start of it in May of 2007. Then, as is common in all these business cycles, you'll notice the unemployment rate begins to rise rather slowly at first. It made a somewhat noticeable move, got to 4.7% in July of 2007 when the feces and fan blades really got together. The crisis begins in August of 2007, forcing the Fed to begin cutting rates in September of 2007 from a high of 5.25%. That was the federal funds target throughout the last half of 2006 and all 2007 to that point. They started out with a 50 basis point rate cut in September 2007, and by April of 2008, the federal funds rate was already down to 2%, so down 3.25 percentage points, including one 10-day stretch in January 2008 where they cut rates by 125 basis points. That's how panicked they were over everything. And Bear Stearns fails anyway. The system continues to go bad anyway. You've got TAF auctions and overseas dollar swaps in addition to these rate cuts. Nothing the Fed does ever works. So the unemployment rate was up to around 5% by May of 2008. Despite that aggressive series of rate cuts from September 2007 to May 2008, in June of 2008, the unemployment rate begins to rise. And by the time we get to September, it's already up to 6.1%. So even before Lehman Brothers, despite all of those rate cuts, didn't matter. Unemployment rate was rising pretty substantially already. The unemployment rate wouldn't peak until it got to 10% in October 2009. And that was after the Fed got all the way down to zero, had the zero interest rate policy introduced in December of 2008. In addition to QE, actually there was two QEs in that initial period. They kind of got lumped together. They did an initial QE and then a couple months into it realized it wasn't working as intended and then basically doubled the size of QE. None of it worked. The unemployment rate continued to rise, got all the way to 10% by October and November, late 2009, and there was no recovery afterward. What good were the rate cuts? Well, what did we hear yet again? We heard the tale of jobs saved. Rate cuts are a superstition with no grounding in facts and evidence. They're just excuses and the pathetic attempt to claim that it somehow saves jobs and keeps it from getting worse. And this is something, by the way, that Milton Friedman describes of the Federal Reserve from its very beginning. This is what he wrote in 1963's A Monetary History about the Federal Reserve in the 1920s after repeated recessions back then. In years of prosperity, monetary policy is said to be a potent instrument, the skillful handling of which deserves credit for the favorable course of events. In years of adversity, monetary policy is said to have little leeway, but is largely the consequence of other factors. And it was only the skillful handling of the exceedingly limited powers available that prevented conditions from being even worse. Jobs saved. So here's Milton Friedman talking about the Fed and its jobs saved nonsense from way back when, and nothing has changed over the century since the Federal Reserve was introduced. Failure after failure after failure, yet the superstition continues to go on anyway. Quite simply, in the absence of useful and established knowledge, human beings make up stuff to fill in the gaps. That's what superstition really is. Oftentimes it's irrational. That is certainly the case with the Federal Reserve and its interest rate policies. And policymakers have exploited that irrationality to create this mythology about rate cuts because it's all about psychology. They call it monetary policy, but it's really psychology. That's what really got Greenspan worried in 1991 when he talked about not being willing to cave in because he realized interest rate targeting was nothing more than psychology. This is not a central bank. This is something else entirely. But that psychology survives time and time again, even though the economy doesn't. As I said before, as we become closer and closer, we get closer and closer to rate cuts with unemployment already significantly higher, should we count on rate cuts to be able to save us from a recession scenario? History conclusively shows don't bet on superstitions. We've been seeing more and more warning signs about interest rates going lower with Federal Reserve interest rate policies joining in. What does all of that mean? Well, I went over that in the video linked below. As always, thank you very much for joining me. Hope to see you next Tuesday on our live stream. Check out Eurodollar University's anniversary sale. Huge thank you, Eurodollar University members and subscribers. Until next time, Take care.